Welcome to Make Your Money Matter with Brad Barrett, the show that aims to change the way you think about wealth management. Brad is a financial advisor, established radio host, and author of Retire Right. He is a managing director and partner at One Capital Management, an SEC-registered investment advisory firm managing over $4 billion for clients across the nation. Brad and his team are dedicated to helping clients protect and preserve their assets so they can reach their investment and retirement goals. And now, your host of Make Your Money Matter, Brad Barrett.
Welcome in to Make Your Money Matter. I'm your host, Brad Barrett. I'm also a managing director and partner here at One Capital Management. Today on our show, we're going to talk about AI, artificial intelligence. Likely you've read, heard, watched many news articles on this over the past couple months, and I wanted to spend some time today and go through what AI means to your investments, what AI means to our world as we see it from a portfolio manager, and ultimately how it may impact your retirement. It's an important technology, and it's important to understand the companies around this. We're going to talk about the Magnificent Seven, some of the companies that we own in particular, and why. But before we get started, make sure to go to our website to find out more about myself or any one of our credentialed fiduciary and experienced advisors here at One Capital Management. You can go to our website at onecapital.com. You can click on the media tab, and there you can actually download and subscribe to the podcast. You can also download the Make Your Money Matter show on the Apple iTunes app or Google Podcasts or Spotify or SoundCloud. And do me a favor, leave us a comment, leave us a review. Let me know what you think about this subject matter, because it allows me to write future weeks and be able to share more of our content. And with that, let's get started. First and foremost, I want to apologize to all my listeners. Last week, if you noticed, I did not do an episode. I was traveling back to our Kansas City office, and I was there about Monday through Wednesday, and I had some ideas to write on, and I figured, you know what, I'm going to formulate this into a better podcast for this week. So I apologize I skipped one last week. And, you know, it's interesting to note, as I was reading through some things last week, that 20 years ago, 2003, was actually the first year we had the registration for the do not call list. Remember this? This is, by the way, before like big time, smartphones in 2007 when the iPhone came out, right? And here's a fun fact that I learned as I was reading through this, that nearly 750,000 phone numbers were registered on the first day of the do not call list. And obviously, those of us who remember, the do not call list was an opportunity to limit telemarketing calls. As I was reading this, I think many of you are probably rolling your eyes, because I don't know about you, but I receive more telemarketing calls on my cell phone than I ever have before. So I don't know what happened in the past 20 years, but that do not call list is not really working. And I also share this because when I travel, I don't know about you guys, when I go to another state in particular, I find I get more calls. I don't know if there's something going on with that. I ended up finding that I was counting between Monday and Wednesday of last week, when I was going to our Kansas City offices, I counted 17 telemarketing calls between 3 days of me being out of state. Now, mind you, that's likely way more than I receive here. I receive probably 1 or 2 a day. 17 in 3 days. If someone else there knows what's going on there, please let me know. But I think it's a good segue, if you think about it, into artificial technology, because obviously these are bots or some sort of technology that's calling for certain sales lists. And I thought it was a good segue into how we discuss some things around artificial intelligence. Now, I want to be very clear about something that, in my opinion, and I think most of the firm, AI in essence has been around for a long time. We've seen the buzzwords come up more as of late. And I say AI simply like think about Siri or think about Alexa. I mean, we don't think that's artificial intelligence. Now, what's been coming up lately that I want to talk about has a lot to do with more of how mainstream has picked it up and the perception we have of artificial intelligence. And I think to share the context here, at least here at the firm, I want to start out with starting this whole conversation with a story and kind of some background into how we see some things, because some of the questions we have around things like NVIDIA, which is a holding that we have in your deferred comp plan for our clients, and I'll talk about that as part of the Magnificent Seven, as I mentioned. But, one of the questions we got is, hey, is it overheated? Is this a bubble? And I'm going to talk about that. And to do that, I want to talk and go back to a time in history, specifically here in California in particular. So early 1848, all right? Any of you Californians know probably where I'm going with this, but the word got out, right, that gold had been discovered Where? Sutter's Mill, for any of you California historians, right, up in the Sacramento Valley area. Now, by June of 1848, many of San Francisco's shops, businesses, they were all boarded up because 3/4 of the male population of that city left to go mining. Now, by 1850, 2 years later, the news had spread around the world, and like 25% of California's population at that time had been born, get this, outside the U.S. The hysteria, as we know it today, was aptly named the Gold Rush. Now, in the years since, and I'll share why I'm sharing this background, this story of where I'm going to tie in the Gold Rush with how we look at AI, the financial markets have had similar periods when what? A group of companies or countries, let's say, were proclaimed gold, like they're given like a catchy moniker, and basically investors flock to them. Friends, I want to share something that I've seen in nearly 2 decades now as a financial advisor and an investor. We are very much a herd mentality. And that's okay as long as we understand who we're following and why. This is a main reason why I speak about the behavioral traits we all have, especially here on our show. Now, in the late 60s and early 70s, it was a lot of the seemingly invincible stocks. And for those of us who are old enough to remember this, right, it was dubbed the Nifty 50, right? The inclusion in this club meant the companies had a strong balance sheet. They had a good balance sheet, high profits, high growth rates, and were bought to be held forever. I'm channeling my inner Sandlot there. These were known as blue chips, okay? This group included things like McDonald's, IBM, General Electric, Polaroid, Sears, Xerox, okay? Some of these companies that we've known forever, this is in the 60s and 70s, were dubbed the Nifty 50. Now, not surprisingly, since human emotions are one valve of the market's heart, as I always share, no real lessons were learned or at least heeded here. And the pattern of giving a clever or really, honestly, silly, name to a hot new investment trend continued. Remember, we're going back to Sutter's Mill, Sacramento Valley, the Gold Rush, into the Nifty 50 of these in stocks I mentioned, McDonald's, IBM, GE, right? We didn't learn a whole lot. Flash forward to the 1990s, we now knew something called the Four Horsemen. Microsoft, Cisco, Dell, Intel. They were coined for the prevailing belief that long-term growth in those emerging economies would surpass that of the world's richest nations. Now, it soon became clear that wasn't the case, and that idea faded. Enter 2013, 10 years ago. Jim Cramer, who loves to dub it, right, popularized the term FANG. Facebook, Amazon, Netflix, and Google. And in 2017, they actually added Apple to form FANG with 2 A's, right? Calling the companies at that time totally dominant in their markets. Today, friends, the industry buzz and craze is the Magnificent Seven. If you haven't heard about that, you're hearing it here now. The Magnificent Seven. This includes Meta, which is formerly Facebook, Alphabet, formerly Google, Amazon, Apple. It adds Microsoft, it adds Tesla, and it adds NVIDIA. Now, the enthusiasm for these companies is so high that they currently make up, get this, 28% of the S&P 500's value. Now, fun fact, real quickly, if you want to look smart and you want to stump some people at your dinner or your barbecue coming up this weekend, know this. The S&P 500, that index, actually has 503 stocks. Take that to the bank. Now, those 7 companies just mentioned, by the way, they're responsible for 45% of the NASDAQ. So they have a heavy weighting here, the Magnificent Seven. This is what everyone's calling it nowadays, okay? Now, real quickly, in anticipation of the question, all right, here at One Capital Management, for our clients listening, we do own 6 of those 7 companies. We're definitely not as saturated in those companies, but we do own them. We currently don't own Tesla, mainly due to its expansive valuation. And by the way, this is, when I say expansive valuation, 58 times next year's expected earnings. For us, as long money managers, a little too rich for our blood. Now, perhaps the only thing getting more attention on Wall Street than the Magnificent Seven is what? Artificial intelligence, AI. No coincidence, all right? Because nearly all of those 7 companies are considered leaders in generative AI. And by the way, others around have taken note.
Stay connected. Get frequent updates on the show. Follow Brad Barrett and Make Your Money Matter on most social media platforms. And catch full episodes of Make Your Money Matter streaming now on our YouTube channel. To schedule your no-obligation appointment, go to onecapital.com or call 805-410-5454.
Now, I want to share something and go back again to the early 2000s to grasp the fixation and the fervor over AI. And I nerded out on this, friends, so I want to share this with you, okay? We have to realize that the number of companies who mentioned this technology or the developing or the use of it in their public earnings reports just hit an all-time high with 110 companies mentioning it in their earnings calls with investors last quarter. So of those 7 I just mentioned, remember, there's 110. Those 7 are the ones leading in that space, if you will. And again, we do own 6 of those 7, but there's 110 companies that have mentioned AI or artificial intelligence in their earnings reports and earnings calls with investors. Now, if this need for companies to be associated with the hottest technology sounds familiar, there's a reason, friends, and this is why I want to go back to 20 years ago. And to do that, let me share a little story or a little snippet of something from The Atlantic. There was a guy named Joe Pinsker who noted in a 2001 study from the University of Purdue, and they had analyzed the outcomes of 95 companies at that time in 2001 that added the phrase or the word .com, .net, or the word internet to their names during the .com bubble. When I'm speaking of 2001, I'm really talking about that technology bubble and the .com bubble. And they discovered on average that the company's stock values increased 74%. 74%, friends, over the period of time from the 5 days before the name change announcement to 5 days afterwards. Simply stated, by adding .com or .net or internet during that time period, it boosted the valuation of these companies because the fervor was just so insane around it. That's what we're seeing today. So our job is to sift through it a little bit. That's the job of any good portfolio manager. Now, Pinsker notes in this study, and I think more striking, and I quote, "This effect was spread across all the firms studied, even those that didn't do business on the internet," end quote. By the way, I mean, this caused, if you think about it, at the time, this caused its authors to conclude that the market's behavior indicated a mania on the part of investors. This is that herd mentality. Again, okay, but let's make sure we contextualize it. So let me just ask a question that many of you might be thinking about this. If everyone's leading to it right now, and that's like the buzzword in the industry, AI, the question would arise is, okay, if that's the case, are we in an AI bubble now? Here's our stance on this, and I was talking to our team on this, and we wrote a folio on this, right? If we are, if so, it's likely in its infancy. I mean, at the .com peak, technology stocks had risen 119% over the immediately preceding 12 months. During this time, they were adding all these names to it. Now, in contrast, this year's technology stocks, if you look at the same kind of fervor and buzz around this, are up a modest 43%. This is, by the way, after last year's plunge, something that didn't happen during the heady .com bull market, mind you. The tech sector is now trading at 26 times the next 12 months earnings forecast, which is, by the way, far below the .com bubble's acme of 54.8. So bubble or no bubble, or maybe baby bubble, as recently Bank of America recently categorized it, right? Things could change quickly with a rate hike from the Fed, something we're on and watching for our clients. Regardless, though, it's unlikely to end in the giant pop as we've seen of bubbles past, mostly because the companies in today's market are equipped with much stronger fundamentals. For those who listen to me each week, those clients listening, you know we speak heavily around the concept of looking under the hood of a car. That's the fundamentals, looking under the hood of a company. Not necessarily how the company looks or how it drives or, you know, if it's got a broken windshield or a scratch paint job or something like that. We care about how it runs and if it's going to run for the long haul. So fundamentals matter. And many of the early coveted internet companies of the 1990s, for example, they had insanely high valuations and, frankly, unrealistic earnings expectations. So very different time periods in terms of this bubble around what we consider AI. Now, AI, guys, it's not going anywhere, all right? And it will no doubt be a game changer across industries. I think a lot of people are thinking it, we're talking about it. Sure, like any technology, it's a disruptor. I always share that. And the way you can even prove that, if you don't even believe me or you're, rolling your eyes, is, go look up something on your BlackBerry. Good luck. Apple overtook that. Technology will advance, whether we like it or not. But again, our opinion right now is it is in its infancy. So throughout history, if you look at it, emerging technologies and the stocks specifically that are associated with them have gone through lots of ups and downs. And frankly, slews of new companies emerge vying for this investment, bringing up even more opportunities. So you're going to have a lot of conversations with people, your colleagues, you're going to have it at barbecues, you're going to have it at water cooler conversations. You're going to have these. And I want to share this on our show as an advisor. And for any clients listening, anytime you have companies like this that are trying to vie for valuations, that's why I want to bring up the context between 20 years ago. Okay. I don't want us to be fooled by it. I'm not saying they're bad investments or good investments, but just saying, understand what's happening around you. But for now, what I want to share is here at One Capital, our firm, we're focused on the practical implications of AI and actually how it might affect the economy. And as investors, we're buying the companies that are established in the field, as noted again by us owning nearly all of the Magnificent Seven, but also companies that provide infrastructure and computing power to those who are developing the potential AI engines, which, by the way, brings me back to the gold rush. So remember, during that time, more fortunes were made by merchants than by miners. Understand that. More fortunes were made by merchants than miners. Studebaker made and sold enough wheelbarrows to start one of America's great automobile fortunes. William Fargo and Henry Wells opened an office in San Francisco. Levi Strauss saw the need for sturdy work pants and redesigned his canvas business. As AI and the mania around it grows, we also want to be the dry goods store, if you will. Not always chasing the gold. We'll find those opportunities, but not always chasing it, but supplying those who come looking to make their fortunes. I sum it up this way. If you're talking with someone and they have some opportunity where it's get in now and all these kind of things, again, I'm not saying it's good or bad, but understand you can invest in this market. You can invest in hot topics like artificial intelligence in different ways. You can be the merchant rather than being the miner. And if you do want to be the miner, make sure you allocate your weighting, if you will, towards that position relative to other areas of your portfolio. Diversification, friends, will matter in this. I want to thank you for listening to the Make Your Money Matter show. As always, remember, before acting on anything discussed today, speak with a financial advisor near you about your specific situation. Or if you would like our help, again, you can visit us at onecapital.com or give us a call at 805-410-5454. And until next week, always remember, make your money matter.
The information in this show is educational and general in nature and does not take into consideration a listener's personal circumstances. Therefore, it is not intended to be a substitute for specific individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.